And this is because monthly policy costs are not being adequately transmitted by the lending rate. Now, again, we compare the lending rate with the treasury bill rate over the same period. So that is the lending rate, that is the treasury bill rate. This is because monthly policy. Hello? Can I go on? Yeah, so this is the lending rate again and the treasury bill rate. Again, we worked out the spread and found that to be also 10 percentage points. I mean, coincidentally, the spread between the lending rate and the policy rate averaged 10 percentage points. The spread between the lending rate and the treasury bill rate also averaged 10 percentage points. Okay, now we can understand why the lending rate will be higher than the treasury bill rate, because government paper, when government borrows from the banks, it is almost risk-free, but banks, when they lend to the private sector, they lend it at a risk. So there will always be that spread. But what you are saying that the spread, the average spread is still high. Now, this is the spread between the lending rate, and savings deposit rate. So again, that's the lending rate and the savings deposit rate average. And you see that the gap is even wider. With the yearly average here was, we calculated it to be 20 percentage points. In other words, this graph is showing us that on a yearly basis, there's been a spread of 20 percentage points between the lending rate and the savings deposit rate. I'm happy that the bankers are here, because we will have to explain why this has been so. We all have to. It's not only me. The banks, I'll hear you try to make a case for that, because your CEO of the Ghana City of Bankers, he's come out, and I'll quote him very soon, saying that you are not responsible for hiring people. It is the economy that's responsible. That's what he said. Okay. Now, the yearly average spread, we think, is too high. And it is symptomatic of several defects in the financial industry, including, we will elaborate on it, the high costs, high borrower risk. So it's not only a problem for the banks, customers also, there's a big risk there. Why then, what I call cohesive behavior in the banking industry. I don't think the bankers would like that a lot. And then customer capture, I'll explain all this in detail. Yeah, this is the lending rate and inflation. Again, your CEO is saying that, it is the economy that is driving the lending rate, macroeconomic instability. Okay, so if interest rates, which is a measure of one of the measures of macroeconomic instability, is high, that is why our lending rate is also high. But again, the average gap has been 12 percentage points, which we think is high. Now, I'll put all the rates together on this graph. I'll put all the rates. So, obviously, I don't have to tell you which is the one on top. It's the lending rate. Okay, so that's the lending rate. And then the lowest, I'm sure you can guess, that's the savings deposit rate. Okay, then the others are there. I think this is the monetary policy rate, the brown line, and then the treasury bill rate is the yellow. And then this is the inflation rate. Okay, so I put all of them together so that you see them, you see the spreads. And the next, this is the data that we have used to draw these graphs, so I don't need to go through them. But the bottom line there is the averages, for all the variables. In other words, the lending rate average 29% yearly. That is the monetary policy rate. And we have seen about 16%. Then inflation, yeah, and so on. Treasury rate. So these are the averages. Now, these are the spreads. So these are the spreads between the lending rate and all the other rates. So we should look at it as a measure of the height of the graphs. It's just telling you the spread. It means, this is the spread between the lending rate and the savings deposit rate. That's why it's height. Okay, and then these are the other spreads. So you measure it by height. Now, if all these measures that have shown you, the levels of interest rates, the spreads, they are all telling us actually the same story. And that's that the lending rates, there's a problem with the lending rate. It is out of place. And something needs to be done about it. We have tolerated it, the high lending rate for too long. And nobody, maybe somebody should take it upon themselves to maybe estimate the kind of the harm in terms of the drag on growth that this high lending rate has impacted to this economy all these years. But that is a very good exercise. So there's something wrong about it, and something needs to be done about it. Now, so I go on to what we consider to be the costs of high lending. That's always an issue. I mean, Bank of Ghana will have a different opinion. Bankers have a different opinion. Government has a different opinion. Let's put it all together and see. Okay. Now, so this brings us to the costs, the reasons behind. I must say that some of us have extensively researched this topic. I mean, high lending rates. I've covered extensively on it. I have been involved extensively in monetary policy as a staff of Bank of Ghana. I was also a member of the monetary policy committee. So I have a lot of history to bring to this discussion. Now, from the evidence available to us, you can say that the causes of high lending rates are, of course, multifaceted. In other words, you can't put it to just one or two causes. They are many. Okay. Now, we can also say with some confidence that the problem, may be placed at the doorsteps of three key actors in the economy. These are banks, government, monetary and regulatory authority. And that's our the central bank. They are monetary authority, they are also regulatory. That's the central bank. I'm saying that all these three key actors should take responsibility for the high lending rates. And if they are responsible for it, then they should also be part of the solution. Okay? So it is good the president drew attention to and the charge of the monetary authority. In this capacity, as the institution responsible for monetary policy, and as the overseer of the entire financial sector, to spearhead the resolution of the problem. So the president is saying the central bank, you are the center of all this. So find a solution. Now, however, I've said that he jointly responsible for the problem that the banks, government, and the monetary and regulatory authority, they have a collective responsibility for fixing the problem. Now, first, banks. And I want the bankers to listen to that. Because I'm going to charge you. I'm going to tell you what your role is as far as the lending rates are here. Okay? Now, of course, we know that like every company, banks would like to achieve certain targets and profits. And to be able to do that, you should manage your income and costs. So your revenue and your costs, you have to manage to arrive at your target profits. Now, the bulk of one's income comes from interest income. When you lend, the income you see on the lending, that's where the bulk of the income comes. Of course, you also invest in government income and then earn income from there. You can really call that interest. Now, so it is logical that banks will always endeavor to keep their lending base as high as possible, so as to maximize their income and profits, given if we accept a certain level of their costs, they want to maximize their income. But the question is whether lending risks maintained by these banks are justified by their costs. So we understand that as a companies, profit-making companies, you want to maximize your income by keeping lending risks as high as possible. But giving your costs. But even giving your cost levels, are your lending risks justified? Now, before I provide the definite answer to this question, let me first look at the kind of costs banks incur and which play a key role in the definition of their lending risks. Now, like other businesses, banks' costs come from a variety of sources. They emanate from structural inefficiencies within the banking system. Now, maybe I'll tell you where they come from. I'll tell you where these structural inefficiencies come from. Some of your costs also come from your operating and overhead costs. I must say that you have costs associated with loan defaults. You have costs associated with fiscal points. You have costs associated with monetary points. Okay? Now, when it comes to the structural inefficiencies, they relate to a variety of factors, such as efficient processes and systems. So you have systems in place that you use to carry out your operations. If you are not that efficient, then you will incur some costs. If you are not doing things more efficiently. Now, paper overload. You know what paper overload is? It means too much paper, paperwork. Then you have, it is a lack of strategic focus of money. In other words, not all the banks have, drafted a strategic focus of planning that will go back. So it's like the business is all like on an ad hoc kind of basis. If you do that, I mean, I'm not saying all banks are guilty of this, but if you don't have that, then of course you'll not be operating efficiently. Then unnecessary location dependency or display of spatial opulence. This is me saying it. Okay? And you get that. I mean, some banks are so much obsessed with showing their head office or something to be the most. You think that when you see people, you are in New York. So yeah, you see some of the head offices of the banks. It's nice to see that, but it's a cost. Okay, now the banks that collapsed during the reforms, some of them invested in this kind of investments, high-rise buildings, just to show that this is our head office. But then you tie in customer funds in that kind of real estate, because it is not a liquid asset that you can easily turn around when you have a problem. The business are running on you. You can't immediately liquidate a building. You can't liquidify it. Okay, so these are some of the problems. And then staff delinquencies. staff delinquencies. I don't have to tell you. I mean, you know the staff of the banks. You know the delinquencies, not coming to work early enough, leaving early, you know, the course of the day, because you are in Accra Central, you just go up into Makola to shop. And all those things. They are all costs. And when we come to the banks to do business, I see you know, some of these. You see it from the staff. Now, all these inefficiencies increase costs. Now, then, how can this happen? Now, so I think that's what I should do. In your operations, you have operating and overhead costs. Sorry.
I think my just
what?
just where the arrow is.
But is it for me to do that or it's for them? Okay. Okay. So your operating and overhead costs. This includes your labor costs, staff costs, material costs, equipment costs, rent, utilities, insurance. All these costs are costs that we have to contend. Okay. Now, loan defaults also represent costs. If you lend money and you don't get it back, it's a cost to you. Okay, so we should acknowledge that. Now, but I must say that, you know, appraisal of customer projects by banks, if you want to reduce loan defaults, you have to have a very good system of appraising customer, you know, projects. I'm not saying you don't have it, but is it up to the optimum? Okay, there are lapses there, and that's why we lose some of the money that. And then lack of adequate identification system for borrowers. Now I understand that the credit reference bureau that were established, I don't know to what extent they are functioning. Are they fully functioning, or are we able to identify borrowers and be able to assess their credit worthiness and make it available to the banks so that we can rely on it when you are lending to somebody? Yeah, and then I mentioned that some of your costs come from fiscal policy, and I meant high and multiple taxes that you face. Okay, and I'll give the details. And then monetary policy costs. Now, the 8% primary reserve requirement. You know, you mobilize the bank deposits. You mobilize the customer deposits of 100. You have to deposit 8 of it with the Bank of Ghana. It is unremunerated. It doesn't earn any interest. So it's a cost to you. Okay. Then, in addition to that, I also know that if you mobilize foreign exchange deposits, you have to cover that in cedis at the bank, not in foreign exchange, so that you bear the exchange risk, exchange cost, and depreciation cost. You bear it, because if there is depreciation, you have to bear profit. That's also a cost. Okay, we have conducted a survey of banks and their costs and how this affects their needs. And they all confirm that these costs that they drive your lending risk. Now, we have not attempted to quantify the relative balances of these costs, but anybody that wants to do that, if you take the bank's financial statements, how much they are spending on labor, you can work out, quantify those costs. Now, during our survey, the banks indicated that staff costs other administrative costs, materials costs, taxes, and utilities were relatively high. That's what information they gave us. Now, Bank of Ghana also recognizes the importance of these bank costs because, and then I remember that during the reforms, in the 2018 banking reforms, and at some point, Bank of Ghana decided to impose ceilings on banks' executive fee. I don't know whether it's still in place. My Bank of Ghana for this year, so maybe. And this is because the bank felt that you were spending too much on your executive and staff and so on. Further, the Bank of Ghana factored banks' costs into this. Initially, Bank of Ghana determined base rates for individual banks. And what they did is that they took your costs and factored them into the determination of the base rates and said, this is your base rate based on your costs. This is your base rate based on your costs. Now, I don't believe that the base rates are in force anymore, but it's been replaced by the Ghana reference rate. Okay? And this takes bank costs into consideration and arriving at the Ghana reference rate. And these, whether the base rate or the Ghana reference rate, they both serve as benchmarks. They are supposed to serve as benchmarks for your lending rates. I don't know to what extent Bank of Ghana can force this. Okay. I don't know. So factoring bank costs into the determination of benchmark lending rates of banks appear to be validating these costs instead of scrutinizing their legitimacy. The point I'm making here is that if Bank of Ghana says, give me your costs, and I will determine a benchmark rate for you. Then you are validating those costs. You are accepting the cost. So if Bank A has higher costs, then I'll tell you, oh, you can lend at higher rates. To be that's the point I'm making. Now, the question even is whether these so-called bank costs justify their high lending rates and their spreads. I don't think it does. And this is because on a yearly basis, banks indicate they make new profits. They are not running at losses, they are making new profits. And since most of your income comes from interest income, and then your costs are here, and you are making this very big profits, something, why can't we narrow it so that you of course want to continue to make those profits because they go to your shareholders and staff and so on. Okay. But Bank of Ghana's financial assessments confirm the high profitability of the banking industry along with other strong financial stability indicators. So the banking system is strong, is profitable, is healthy. But if this is the case because you are sitting on these very high lending rates and spreads, and it is not coming mainly from the fact that you are more efficient. I have a problem with that as an economist because it looks like you are passing on your inefficiencies to borrowers and earning so much profit. But the bankers, these are things that we should begin to question. Well, the Ghanaian banking system is also known to lack equal competition. Well, there's some competition in the increase from my own experience. Competition in the banking is increasing. Over the years, the authorities have tried to license a lot more banks. There were a few banks in the system before. Over time, the Bank of Ghana started licensing a lot more banks. And it was believed that by bringing more firms, more banks into the system, it will generate more competition. That was one of the reasons behind trying to license small banks. But has that really happened? Have we achieved that kind of competition? Now, anybody familiar with the banking system will attest to the fact that it remains a highly concentrated or elusive system, lacking competitive product pricing, and having a tendency to copy yourselves in setting interest rates in order to enter attract. So these are very serious allegations. Okay, so you have to be ready to refer to it if you can. Okay. Now, meanwhile, there is a clear evidence of what we call customer capture. This is my own expression. In other words, we have in this country a tendency whereby banks are able to retain their customers, no matter how uncompetitive their product pricing is. Even me, I'm supposed to be an enlightened economist. I've been captured by ABSA for 10 years. You know, once you start banking with somebody, you don't feel like, oh, let me do and you can start with them. 10 years I've been started after. But I don't believe that they are the most efficient bank. I don't believe that. So there's an element of customer capture. You capture us, and because of that, you give us any price. You can calculate that from, sorry, a ABSA. Maybe I shouldn't mention. But you know, sometimes the issue is that we are increasing our charges. You know that banks don't pay, I don't know whether some banks, many banks don't pay interest on our foreign exchange, foreign currency deposits. They don't. And why not? So these features of the industry manifest in elevated lending rates, depressed deposit rates, and the last rates. I think then this is what we are seeing here. I'm just repeating the spread between the lending rates and savings deposit rates. I think I've mentioned it before. Look, the spread has averaged 20 percentage points over a 20-year period. How do you justify that? This is not a normal banking system. You know, if we have an efficient banking system, this spread shouldn't exceed 5%. Why have we tolerated 20 percentage points for forever? Now, we wish to point out that the high lending rates, it's not even the only problem with the banking industry. There is a plethora of equally high charges associated with loans or other financial services that customers have to deal with. But they do not attract as much attention. You see, we talk about yes, high lending rates, but there are other charges and fees on financial services that we bear, because I use the financial, I transfer monies abroad and so on. And then you'll be amazed at the charges. And because I'm transferring 500 euros, you know, and you see the charges. Nobody is going there. Now, these include, in connection with loans, they will charge you something they call arrangement fee, processing fee, commitment fee, facility fee, insurance fee. I took a loan from a bank and they said one of the conditions, the terms of that, if you pay us back before the maturity of the loan, you will pay a charge. Yes, the bank, don't you do that? If I pay you back the loan before this maturity, okay, I took a loan for 3 years. After 2 years, I tell you, I'm capable of paying back the loan. He said, you pay us any more than the maturity, you have to pay this additional fee. Okay, don't you do that? You do. What is the justification? Not all banks. Well, and so Well, this is that's now equally high are charges levied for other financial services such as use of credit cards, use of ATMs, foreign exchange transactions. Now, I expect that the Monetary and Regulatory Authority will go here also and try and look at those charges there and try and do something about it. We cannot leave customers at the total mercy of banks. I have lived in the US for 10 years, and all these, fees and then they are regulated. They are regulated. When you leave banks, they will do everything. They are regulated. So why not in Ghana? Even the most capitalist free market economy in the world, the US, they regulate these charges. You cannot charge anything on somebody to see your credit card or ATM. I have my own foreign exchange deposit in the bank. If I go there to withdraw cash, they say you have to pay the fee. Because you didn't come to deposit cash in the first instance. Well, now, so that is banks for you. That is your role in as far as lending rates. Now let's return to government. Now, government is also a contributor to finance. And government, it's important that government recognizes this and becomes part of the solution. The Ministry of Finance, they are here. Ministry of Trade also here. Okay. So the first channel through which government affects lending is the borrowing from banks to finance development. Once government is borrowing so much from banks, finance development, government is competing with the private sector for loanable funds, and it puts pressure on the price, which is low interest rate. That's simple. Okay. Now, then those high fiscal deficits, they have been generally high in Ghana, and the government has relied heavily on banks to finance them. So by competing the private sector for loanable funds, government borrowing is fueling the lending rates. Oh, this is again the Treasury bill rate, I believe. So the Treasury bill rates, I think we have shown it before. I'm saying that because it's rates very, very high, government has been competing. Because this is the most risky, security. So if banks are lending to government at these rates, why would they lend to the private sector at those higher rates? Now, there's also evidence that Ghana has a history of macroeconomic instability, of which high deficits have been a contributing factor. And now, high interest rates generally tend to be a feature or symptom of macroeconomic instability. In other words, when we talk about macroeconomic instability, there are so many variables there. The inflation is there. The exchange rate, situation is there. Government deficits are there. And then interest rates. All these are measures of macroeconomic instability. So I'm saying that once you have macroeconomic instability, you don't expect to have very low interest rate. And that's what the Ghana Association of Bankers President should say. He says there is the general macroeconomic instability in this country. And lending rates are high, but they are part of it. In a way, I agree. That's what I'm saying. So let me. High interest rates generally tend to be a feature of symptom. Therefore, high deficits will affect lending directly through borrowing from the banks to finance the deficits, and indirectly through macroeconomic instability. Now, another channel through which government policy influences lending rates is taxes. Now, banks have faced high and multiple taxes over the years. Again, I want the Minister of Finance to help me because this is information that I picked from a source, and I just want to be sure that these rates are appropriate or applicable rates. Because I picked that corporate tax for banks listed on the Ghana Stock Exchange is now 37.5%. If GRA were there to confirm it, or maybe Minister of Finance, and that it is 40% when you are not listed on the Ghana Stock Exchange. This is what I picked. Okay. Now, in addition, banks also currently pay 5% fiscal stabilization levy and 5% financial sector bailout levy. Okay. Now, this first one, 5% fiscal stabilization levy. Do you know where it came from? Since 2001, that it was imposed, and government said, and the new government are taking over. So this economy has been destabilized. Okay, so let's levy banks, some taxes to help stabilize the economy. Now, you see that it says fiscal stabilization. Now, this economy has been destabilized by fiscal policy. It wasn't the banks that destabilized the economy. Okay. Fiscal policy has destabilized the economy, then you go to banks and say, now pay for it, contribute to it. And then it's been there since 2001. And every government that has come has, kept it there. I don't even find a justification for it in the first instance, let alone keep it all these years. Well, as for the 5% financial sector without levy, and it's a temporary levy, somehow I have some sympathy for it in the sense that I've also argued that since the more successful banks were all part of the bigger system that, change distress. So some banks face distress. But because of the interconnectedness between you, I'm saying that if you did very well, maybe you did so at the expense of some of the banks. Because the banks you trade among the interbanks on the trading and so on. So if they are asking you to help pay the cost of the cleanup, I am prepared to accept, but I'm not expecting that it will be there forever. So now I've spoken about how government contributes to the lending, and then I'm going to my friends, my good old friends, the Bank of Ghana. Yeah, I call them the Monetary and Regulatory Authority. It's the third key influencer of banks' lending rates. Again, it is important to recognize the biggest contribution of the authority so that we rope them into the search for the solutions. So the point I'm trying to make is that these three parties, these key parties, nobody should stand out of the ENC. I am not part of it. I'm not responsible for it. It is you. So you find a solution to it. I'm saying that all these key actors are part of the problem. If somebody is not willing to contribute to the solution, then maybe something more drastic should be imposed on them. Yes. Now, the Monetary Authority. Now, the policy rate is the overall benchmark for other interest rates. You know that. So the central bank uses it in responding to inflation. So if inflation is rising, they raise it. And if it's going down, they tend to lower it. And the central bank lends to banks at the policy rate plus a margin. Okay. So a change in the monthly policy rate is a signal to banks also to adjust their lending rates. So I'm getting more funds from you at a higher price, a higher cost. I also push up my lending rates. So the policy rate, Well, again, this is, I think, the relationship between the lending rate and the policy rates. Okay. Now, you see, oh, is that right? Sorry. This is monetary policy rate and inflation. Now that I'm saying, what I'm trying to say is that the policy rate is not adjusted in response to what is happening to inflation. Okay. So as long as inflation has been quite endemic, high in this country, you should expect the monetary policy rate to be chasing it. Only because inflation goes to go up. It comes down, it comes down. And in that sense, look, the monetary policy rate averaged 19% yearly during 2020, for the 20, on average, 19%. Okay. Why was it there at 19% on average for 20 years? It is because it is responding to inflation. If inflation had come down, it also had come down. Now, because the monetary policy rate has been maintained at these high levels, in an attempt to control inflation, to the extent that the lending rates are just somewhat in line with the monetary policy rate, I'm saying that the monetary policy rate has also fueled the high lending rates. Okay. Well, okay, I made a point here which I should go back to. Historically, you see, when the monetary policy rate is increasing in response to rising inflation, lending rates tend to follow very quickly. That's what you see. When Bank of Ghana adjusts the policy rate upwards, lending rates will just adjust it quickly upwards. But when the policy rate is reduced, the lending rate comes down a bit more slowly with the lag. Okay. So in that case, the response of the lending rate to the monetary policy has been asymmetrically biased upwards. Look at that. Okay, asymmetrically biased upwards. So when they go up quickly. When they come down, then you are slowly responding. So they are upward bias. Now this is the monetary policy rates and the lending rates. So the same point I'm making that there's a relationship. So once the lending rate that has been at or this level, you can say that, well, they can say they have been responding to the policy rate. Yes. They can't come below the policy. Now, I also mentioned reserve requirements, and I think I've made the point already. So let me quickly say that I think the 8% reserve requirement, okay, contributes, it's a cost to banks. And then the fact that they also have to keep the reserves against the dollar, against dollar deposits receipts. Okay, it means they have a cost. There's a cost there also in terms of exchange losses and so on. And when I come to the solutions, I'll tell you by what I think you should be thinking about it. So I'm trying to see if there's any justification for this primary reserve ratio being high. And I just want to explain to you that the reserve requirement is serves two purposes. It serves a monetary policy purpose. In other words, because you have to keep part of your deposits with Bank of Ghana, the base with which you can create money is reduced. So it's a monetary control measure. One. Secondly, it serves as a prudential. It serves a prudential purpose in the sense that when customers deposit 100, Bank of Ghana says bring us 8. That 8 is somehow serving as insurance against the deposits. In other words, if the bank failed, at least 8% of the deposits is Bank of Ghana. So we serve that prudential purpose. And I'm saying that I'll argue that for the monetary policy purpose, the fact that we are operating inflation targeting is not that. The level cannot just. Now, if credit reference bureaus, okay, if they were working well, okay, then they will help reduce borrower risk. But I'm putting it here because I think the central bank is the authority that is supposed to regulate, set up, and regulate these things. So I'm making it a responsibility of the central bank that maybe the credit reference bureaus are not working as expected. And therefore, this also feeds into the bank's costs and then the lending needs. Okay. So, did you touch anything? Because I haven't touched anything. Imagine. Seriously,
Yes, that one.
So let me put this professor very good friend of mine, I communicated with him. And then he is talking about the currency board. Okay. Now the difference between a currency board, the currency board is modified like central bank. The currency board is like a central bank, but it doesn't lend to government. All the money that is supplied into the economy is directly by foreign exchange, 100%. There are a few currency boards around the world. They are for normal, small island, small countries and so on. Okay. But given that government borrowing from Bank of Ghana or from the system, creating instability, and then the monetary authorities role also in all this. So he has said that maybe a currency board, which is not a currency board in place. In a currency board system, there is very little inflation. There's virtually no balance of payments problem. Because you don't issue too much money that you don't have foreign exchange to cover. Here in Ghana, our currency that we have issued, there's a certain coverage by foreign exchange. It's not 100%. Okay, so this is from Sam Kennan, and he said, in the beginning, God created the sterling and the franc, those two currencies. On the second day, he created the currency board. And lo, money was well managed. Because I told the currency board system, you can't mismanage, you can't lend to government. Whatever currency you issue, you must have foreign exchange backing for it. So if somebody comes to a bank and says, I want to import something, and he brings you have the dollars to pay to that. There's no excess. Now, on the third day, God decided that man should have free will. And so he created the budget deficit. Okay. So, you can have a budget deficit. Okay. And on the fourth day, however, God looked upon his work and was dissatisfied. It was not enough. So on the fifth day, God created the central bank to validate the sins of man. On the sixth day, God completed his work by creating man and giving him dominion over all God's creatures. Then, while God rested on the seventh day, man created inflation and the balance of payments problem. While God was asleep, the central bank and the government, they teamed up and created all this instability and balance. That's the bit, the first one, you get the sense. Sure. I'm not advocating for currency board for this country. Is it? Sometimes what I'm saying is people misinterpret it to mean that, but you want to take us back to a control regime in the system. I don't want to take anybody back to a control regime because I lived it. The system of controls in this country, some of you are not sufficiently old enough. We lived in a system, a country where everything was controlled and everything was in short supply. Because in economics, if you control prices of things, you reduce the production supply. Those who are producing, if this price is not attractive, you produce. Those who are buying also have, because the price is low, the demand is excess. So those of you who are producing will want to buy something before importing it. That's the thing that what we have gone through in this country before. Everything was in short supply. Goods, services, foreign exchange, toilet roll was in short supply. Everything. Essential commodities economy. I don't want this to go back to our foreign exchange. We used to control foreign exchange. There was a black market. Okay. There was a time that I remember, if I correct, the CD was exchanging the official, so you are controlling prices. So you say the official exchange rate of the CD is 2.75 cedis per dollar. Control fixed for the banking system. On the black market, it was selling for 80. 2.75 officially, 80 unofficially. I don't want this to go back to the system. Okay? So whatever I say here is about regulation, not control. There are two different words. Now, graphic online, September 7, 2021. And this headline was, this is coming from the Ghana Association of Bankers, your CEO. Somebody said it's from Ghana Association of Bankers. Huh? You are the CEO. The CEO is here. Oh, Mr. Joanna, who are you here? You are the one. Oh, good. So I'm putting you directly. You said banks, unless of course you are really disputing with what you are quoting for it. Banks have disagreed that the cost of borrowing is too high, explaining that the high interest rate regime is a reflection of the current economic conditions. He said that. The CEO of the Ghana Bankers Association, who told the graphic business yesterday that the rising cost of living and business operation had combined with other macroeconomic indicators to keep interest rates high, a situation he said is outside the remit of banks. But from all that I've said today, will you still stand by this? Oh, then I've not been successful in my lecture community, my presentation. I've not been successful at all. What I would try to say is that all of the banks, government, the money this, you are all responsible for the problem. And join us in addressing it. Nobody should say we are not contributing. You said it's outside the remit of banks. It is not. Because that spread that you maintain between lending rates and deposit rates. Why do you justify that? 20 percentage points over 20 years. And this is all feeding into your profits. And that is why you can pay your staff what you pay them, and then your executives see what you pay them, and maintain those machines as your head office. And you think we should sit down?
No, I'm sure we'll have some time to talk about it. That's why we should.
Okay. Nice, good together. Now, so given that banks, governments, I'm repeating us, monetary and regulatory success are generally responsible for the problem of high increase. What do we want them to do to address the problem on a lasting basis? So that takes us to the solution. My recommendations. Okay? First, to banks. If you address your operational inefficiencies to reduce your costs, so that you don't pass them on to customers. It's very difficult for anybody to admit that my systems and processes, they are not very efficient. Nobody has achieved perfection when it comes to efficiency. So all that we are saying, there's room for you to maybe modernize digitization, these things, so that at least okay, I hear you. But let me, because the recommendations are even more important. So let me please have a lot of information for us. And then let me take you through our recommendations. I am being told that I should hurry up a bit. Okay. Well, under COVID conditions, I can understand why we should shorten the way we do things. But before COVID, I have a problem with Ghanaians when they go to events, meetings, conferences, they will publicize their thing so much that it was a very important to hear this person is coming as a guest speaker and all this. First, they'll start the program late. And then they rush through it. They say, oh, somebody that was supposed to speak for 30 minutes, you can speak for just 15 minutes. And then they rush through it. They don't get to any concrete things. And they go and have lunch and then they go and I have been part of food for you before. We need to discuss it. We don't give ourselves enough time to discuss the problem. Now, I'm coming to my recommendations. So please, Rama, don't try to stop me. because this is even more important. Now, the bank should improve your working processes. Okay? Please, we'll give you a summary of my speech. Okay? And the summary focuses mainly on the recommendation. So you have. Now, in general, you should also reduce your paper load, economize on your time, avoid unnecessary location dependency, reduce incidence of staff dependencies. It's just that all the things that increase your cost. I'm just asking you to do something about that. That's all. I'm just like to repeat myself. Once you identify what's the cost of the problem, then naturally the solution is to say do something about the problem. Okay. Now, you should reduce your operating overhead costs and so on, labor costs, material equipment and so on. Your capacity, strengthen your capacity to appraise customer projects so that you reduce the incidence of loan defaults and all these things. Then government. Now, again, government should do something about this borrowing from banks. Okay, so we keep the deficits under control. Okay, now the bank taxes. Okay, government should do something about it. Streamline those taxes. I would want the bank to be given the same level playing field when it comes to corporate taxes. Like other companies. Even now, if you give them that level playing field, they will have no excuse to say, I'm paying higher taxes and then whatever I'm charging higher interest rates. Now, if you want from time to time to impose additional taxes like the bank bailout tax, temporary, because you want to address a particular problem. Or maybe some sector of the economy is booming for whatever reason, you want to impose a temporary tax. I'll go for it. But not to say that your corporate tax rate should be so high. But they will certainly feed it into their lending rates. Now, so that's taxes, sorry. And then, so that's taxes. Then together with the monetary authority, that's what I'm asking government to do. They should promote and support para or specialized financial institutions, strengthen the legal banks, the national development fund that we want to establish to offer accessible funding to SMEs and strategic sectors of the economy. In other words, I'm saying that there is a traditional banking system whose interest rates are so high, SMEs can't access those loans. Okay, so as a developing economy, try and create parallel, institutions that government and the central bank can support, so that the SMEs and so on can go there. We have tried some of these things in the past, but you have to be careful that people don't regard those loans, as a government money, and therefore we pay back, and you have to put in structures to be able to. So that's what I'm saying. You provide this so that at least you remove the burden or the load on banks and then take it somewhere else. And that's what I'm saying. Now the monetary authority. Naturally, because you are the regulator, the monetary authority. My list of recommendations for them is the longest. I think you should understand that. That's why the president in charge. The president thinks that they are the ones responsible. Okay. Now, I've told you that in fighting inflation, the monetary policy rate is chasing inflation, and the lending rates are chasing. Okay. So maybe we should find a way of managing inflation such that we don't do that. And then this is something that I was on the West Coast for 10 years. The framework that we do, the inflation targeting framework, is like a demand management. You increase interest rate, the policy rate, you expect banks to increase their rates, pass it on to their customers, so that their customers will borrow less, and therefore you have less credit going into the economy, and then reduce demand in the economy, demand pressures. That's how we try to control it. Now, the tendency, the fear is that if we do that exclusively, okay, and you're always chasing, addressing demand pressures, and maybe you are not also looking at what is happening to the supply side. Once yesterday I heard about that the inflation figure for August is out. I think it's 9.7%. And the last July also it went up. Okay, and I believe I have to go and look at it. I believe that those supply side factors like food and so are feeding into it. So the next meeting of the Monetary Policy Committee, which I'm sure will take place this month, okay, we're seeing this rise in inflation 2 consecutive months. We are going to respond to that. Okay, and I would say that they should raise the policy rate. If they raise it, the bankers will also raise their rate. So we are even going to move away from where we are trying to get. Okay, but if it is food, how do we all come together and address that problem, that supply problem? Okay, planting for food and jobs, they said it is a thing, but this year they said because of rains and so on. Okay, but that's what I'm saying now. On the longer term, let's try and address the supply side problem so that the monetary policy doesn't become an inflationary fueling process. And then the primary reserve ratio. I am recommending that the central bank reduce it from the current level of 8% to 5%. Okay, this is my recommendation because I'm saying that the 8%, it's to me it serves more as a prudential, it serves a prudential, and there are some systems, some economies that have zero primary reserve account, zero. They don't require the bank to be not GDP. We are not there. We should keep a margin, especially if our deposit insurance schemes and so are not working that well. Okay, we should have some of it there as an insurance. But let's support the deposit insurance scheme so that to work well, so that we don't have to keep this much money with the central bank as a form of insurance. So that is the fundamental recommendation I'm making. And then when it comes to the fact that banks cover their dollar deposits with CDs, I tell you that's a cost, exchange cost in it for the banks. I will recommend to my colleagues that they should let banks cover foreign exchange deposits with them with foreign exchange sales to the bank. One-on-one, giving them. And then deposit insurance scheme that the Bank of Ghana supports that. They should work effectively. And the credit reference bureau also, let's support them to work so that we reduce moral risk and incidence of low defaults, which also feed into bank costs and the high revenues. Then the monetary authority should keep customers continually informed about interest rates and other charges in the system. I've seen that they've been publishing the lending rates of banks. Okay, that's good. They should probably publish it so that everybody will know. But if they give me the fact that we have customer capture, I doubt whether when people see these rates, lending rates, but do they also publish deposit rates? They also publish deposit rates, so that we know which bank is offering higher deposit rates than others. But is there enough opportunity for people to move from a bank to bank? Is there any such opportunity? You don't move, do you? You don't move, you are stuck with one bank. Why? But you need to have a victim to it. And I don't know why I'm stuck with them. And then the most significant and the potentially most effective intervention that I want to recommend today. And I know that the bankers will not like me for this. But I have to be honest about this. You see, all the recommendations that are proposed upstairs, they are sort of voluntary. You see, banks do this, monetary authority do this, government do this. They are following. I'm asking them to do it. I'm asking banks to reduce their costs. Do you think when they go away from you, they are going to do that? I don't know. And they have been saying it forever. So I think that, instead of giving these recommendations at the voluntary level, let's introduce things that are more interventions. Say, this is what you should do. And I'm recommending that the Bank of Ghana should regulate the difference, the spread between the lending rate and the monetary policy. They should regulate it, not control it. Okay. Now, this will force banks to follow the monetary policy rate more closely and keep their lending rates within certain bounds. Okay. And I am recommending that this year, as a first scenario, and I think this will be the one that is probably more manageable. I'm asking the monetary authority to impose a ceiling of 5 percentage points on that spread between lending rates. Okay. So at the next monetary policy committee meeting, if they decide that they are maintaining the lending rate at the policy rate at 13.5%, I want them to ask all banks to bring their lending rates 5 percentage points within that. Okay. Are you getting me? So the higher that any bank can post to their lending rate should be 18.5. If you want to put that 16, that's fine. I don't want to follow that. But don't go beyond 18.5. Or I have a second scenario, but that is very complicated. And I am trying to link the lending rate the spread, rather with the reserve requirement, which is money equal to money. In other words, I'm saying that if a bank keeps, you maintain the 5 percentage points in the previous month between your lending rates and the policy rates, right? Link up to your reserve requirements. Okay. Now, when you maintain 5%, I'll give you reserve requirement of 5%. Okay. If you maintain the gap 8%, your reserve requirement is 8%. This will be an incentive for banks to keep the spread to a minimum. Now, I think this will be a frequently changing reserve requirement is equal to money, so I don't know how that can be done. So I'm still talking about, and then I make the point here that these measures will be temporary and could be changed as needed. They should not be seen as controlling lending rates in the strict sense of the word, a regime that nobody wants to revisit. It will only amount to regulating them. Please, do you see the difference between regulating and controlling? The bankers won't see it, I mean. You won't see that. Okay. So I'm still justifying the position of the spread. Now it has to be said that this will also not be the only regulatory rule in financial transactions. We know that, again, you must correct if I'm wrong here. When banks buy foreign exchange from the monetary authorities, is there a ceiling as to the rate at which you can sell it among the banks and then with your customers? In other words, if you buy foreign exchange from Bank of Ghana at a certain price, the Bank of Ghana impose ceilings on you as to when you also go and sell it to interbank or with your customers. Is that a ceiling? Yeah, so that's also regulation. Why do I accept that and not accept that? That's also regulation. It's what? It's different. It's different. Yeah. When you buy foreign exchange for Bank, I'd say the dollar, they sell dollar to you, they say pay us 5.8. They tell you that when you can't sell it above 5.85. They tell you that. But it's not regulation.
The difference is in the FX market, Bank of Ghana is providing the FX. So Bank of Ghana is saying, I'm giving this FX, give you this margin. So there is that margin. But if you place a cap on lending, you have not provided my funds. We don't know where the customer provided the funds. The customer is provided, but I don't know where the funding is coming from. Yeah. In all these discussions that you are using savings, you are using current account, the current account will not come to you at 100%. Yes. So if I'm lending 3 years out for 3 years, yeah, I cannot get 3 years. I don't know how many people here can say about I'm keeping this $1 million for 3 years. And therefore you can do this monthly 0. So when a bank has to look for that kind of funding, you look for wholesale funding to support that kind of lending. So you cannot use the average interest payment on the current account savings to justify a spread between lending rates for a long-term financing and the deposit. I think it's a mismatch.
You look for wholesale, we say wholesale.
Yeah, okay. I'll give you a very simple example. If today a bank wants 2-year money, giving money to this manufacturing company, $10 million. I don't have in my Bank of Ghana saying match your assets with your liability. Okay. So I can't use a short-term fund to give a long-term loan. Okay. So if I'm going to give a long-term loan, 5-year, I have to look for money which is at least 5 years in term of maturity. So I go to a pension fund and I say, can I get 10 million so I can lend to GMPC or any other? The price the pension funds are demanding is treasury bill plus something.
Mm.
So there is a fundamental flaw in the whole ecosystem. So at that point, if you then go and pick my balance sheet and say I pay maybe 6% in savings account and lending at maybe 16% or 18%, you don't know that I picked that 10 million from a pension fund that gave to me at maybe 14.5 or 15%.
Yeah.
And you just talked about the cash reserve requirement. If you discount it, the effective cost of that deposit or funding is about 16.5 to 17%.
Yeah.
I've not paid my salaries. I've not paid for my infrastructure. I've not paid for my operations. I've not paid for default risk. So at what rate can I lend a cost base of 16% to still be profitable?
Yeah. Okay.
So these are practical issues.
Yes.
You know, and it's very easy to look at the balance sheet and wish it away, but it cannot happen.
Yes. I understand. I appreciate that you have various sources of funding. It's not just from personal deposits and so on. I'm aware. But I have seen the bank when they do the analysis of the sources of funding. For instance, I mean, term deposits, time deposits. They are a substantial part of the fund, as I see it, when they do presentations. But to me, all that you have said is fine, trying to defend yourself as you can. But to me, the bottom line is you make so much profit. That's me. That's my bottom line. And if you are a company, a firm operating in a system, a country like this, okay, you must be prepared to share your, I mean, you cannot say, I'll continue to make so much profit. I don't care about what goes on in the system and so on. I'm saying that you must have this culture of, you must develop this culture of, exactly, that I want to share with the community. Now, Bill Gates made so much money. Okay, yes. You realize that he has made it at the expense of all of us. Okay? And it's a great problem. Give you back some. He and the wife, they set up that foundation. Because where did they get the money? They got it from customers. We buy their computers and so on. That's where it came from. I'm saying that you are also in the end making so much profit. Where is it coming from? It's coming from this system. So give some part. We'll come to that. Yeah, okay. So once authority and so on. We have heard said that if you regulate banks lending rate, they will refuse to lend. Okay. No, me, I don't believe they will refuse to lend. If government reduces its borrowing from banks by reducing the budget deficit, as we are saying, but what business will you do? If today government stops borrowing from you, and you said, I'm asking this Bank of Ghana to regulate this spread, so we will not lend. Will you sit on your personal deposits? Will you sit on the idle money? You will lend. Only that your profits will reduce. It has also been argued that banks will likely depress deposit rates to maintain the existing spreads. In other words, if you impose some regulation on them like that, they will go look for where recoup. They will go to deposit rates and really depress them further. You get me? To limit that outcome, possible outcome, I will even recommend that. Well, depositors should be empowered by providing them with adequate information so that they can shop around. They can protest with their feet by shopping around for the best deposit rates. Otherwise, I will even be minded to suggest that a ceiling of 10 percentage points should be imposed on the spread between the lending rates and deposit rates. Why do you take our deposits and you pay us 8%? And you go and lend it at 20 something. So the problem there, it's only Ghana that this will happen. Now, I want to repeat that the suggestion for regulation of the lending rate is only meant to be a temporary measure that will be monitored by the monetary authority and change whenever it finds it necessary to do so. And I'm also calling on the monetary authority to regulate other financial charges and fees, including those levied on loans, use of credit cards, use of ATMs, foreign exchange transactions. Okay. Now, financial services like other goods and services that are used on a universal scale everywhere. The goods and services that are used on a universal scale, like water, electricity, public transport, postal services. Okay, they are regulated. I've lived in America, all these services are regulated because they are used on a mass scale. So you cannot allow one supplier to take us to, ransom. And I'm saying that financial services are also used on a mass scale. They should also be regulated. The prices. Now, then I've said that this is the para institution that I said the money of this team of government to provide this. The para institution that can provide para credit to SMEs, and so that's what I'm repeating there. Again, I'm repeating that this should be a joint responsibility of banks, government, and the monetary authorities. We should, if we are to be successful in the bringing interest rates down, we should go beyond the orthodox moral suasion and free market-based approach and adopt, I think, a more interventionist approach. I'm sure that one of Ghana, once that they have received this instruction from the government, she's going to call you and sit down with you and say, please, we beg you, reduce your lending rates. The moral suasion hasn't worked. Do you get me? So I will go in for some more interventions, regulate. Okay. In any case, the proposed regulatory measures and interventions are meant to be applied on a pilot basis. Should they be seen to be ineffective or counterproductive, they can be reformed accordingly. But to not act, I don't think is an option. In other words, if we don't act, then it's not an option. And I believe I've come to thank you. I'm sorry that the grammar things are taking too long. And then, please, moderator, I continue.
Yeah, I think it's starting time now. So, okay, please. What is this guy? Yeah.
Okay, thanks for your presentation. Yeah, Solomon Tekiakin, Deputy Institute of Bankers. Institute of Bankers, Solomon Tekiakin.
Okay.
Yes, you mentioned the Ghana reference rate, which is the case with all commercial banks. And you also mentioned T-bill rate, then the cash reserve ratio, the monetary policy rate. And what I want to say is that all these have been factored into the model of the Ghana reference rate. And the benefits, the Ghana reference rate was meant to drive interest rates down. And that has been achieved to some extent. Between April 2018, when it became effective, to date, it started from 16.82. It's come down by about 3.6%. The GR has reduced by about 3.6%. And per recent Bank of Ghana Financial Sector report, average commercial bank rate has reduced by about 4% between April 2018 to date. So what I want to say is that banks have actually responded in reducing interest rates in tandem with the Ghana reference rate. Then one thing I didn't see in your presentation is the yield curve. The yield curve. If you sit in a bank as the treasurer or the CFO, and the shareholders are giving you some quantum of capital to manage. And then you see a customer, a borrower coming for say a 1 year loan. And then you see the central bank of government saying, I also want to attract deposits, and my 1 year note is 16%. Then irrespective of the Ghana reference rate, you know, I'm also looking at an alternative benchmark rate, which is giving me 16%. So any rational person, look, there is some risk premium if I link to the borrower. It may default at that time, but this is 0 risk, and it is 16%. So effectively, at the back of my mind, my effective interest rate to the borrower should take account of the 16%, which is an opportunity cost for me. So irrespective of Ghana reference rate, I'm looking at another benchmark rate, which is 16%. If the customer says it's coming for a 5-year loan, I'm looking at government 5-year notes. It is 18.5% risk free. So, irrespective of the Ghana reference rate, my effective interest rate to somebody, a borrower, for 5-year loan from the bank, I'm looking at 18.5%, which is risk free. Then I'll add a risk premium. And that is where you would say interest rates are high. But that is the reality on the ground. Government is offering 5-year notes, 18.5%. So any rational investor, CFO, treasurer, say, why would I then below 18.5% for a 5-year loan when you know you have a risk-free, I can sit down, go to bed, now earn 18.5% per annum. So it's something which was missing in your presentation, and I think that will set things in perspective.
Thank you very much. I think some of the things that I want to talk about are highlighted. I think the discussion and thanks for the presentation is quite broad and it gives us a lot of food for thought. Thank you very much. The discussions, as I summarize the whole trend of the discussion, is leading to a regime of interest rate cap. I think as a country, we must tread very cautious, extremely cautious. We can only cite one country in Africa that introduced interest rate cap in 2016, and that is Kenya. In 2019, they did a 360-degree U-turn and went back to free market determined interest rate. It has not worked anywhere, and we should be very careful not to be pushing an agenda. And I saw your presentation saying, if it doesn't work, it will come back. By then, we would have hurt the economy big time, and coming back will be significant cost to the progress of the country. That is one thing. That is my preamble, and I think it's a very important point that we have to take from here. That whenever somebody is pushing an agenda for caps on interest, you must know that it is going to hurt economic fundamentals. It's going to lead to reduction in credit creation.
and it will be a squeeze in liquidity in the economy. And we should never even anticipate or encourage it. That is my first point. The second point is the range of the periods for the presentation, 2000 to 2020. I think for an economy the size of Ghana, the volatilities we have experienced over that period, any comparison of the 20-year will not send a signal of what we need to do. Because the spread of 20% that was hammered and hammered doesn't exist. It does not exist. In the year 2000, the policy rate was at what, 27%. Treasury bill rate was at 34% in the year 2000. 34. So if you just suppose that over current bill rate 13.5% and policy rate at 13.5%, and it is lost in the average. The message is lost in the average. Comparing that level of volatility within that comparative periods will send a signal of an issue that we must address, which does not, in my view, exist. So that gap or margin of 20% is not an existing margin. Currently, the average interest rate in the market is at 20%. If you say that the spread is 20%, it means that the bank's cost is zero, which is not a situation that we want to debate. A 5-year trend, perhaps, would have given us a very good view of where the market is operating and how the country should respond in line with the market fundamentals. And I must say that as banks, we have every interest in lower interest rates because it is our view that higher interest rates contributes to higher default rates. If the interest is not affordable, the propensity for the customer to default is higher. And that is a cost to the banks. And with non-performing loan around 17%, it is in the interest of every bank because we don't make our money from the top line, we make our money in the middle. It is in the interest of every bank that interest rates are affordable and it can be expanded. When the cake is bigger, even a small interest, you can make a lot of money. So it is also an issue that concerns banks because it has an impact on the bottom line of banks. My friend has talked about the yield curve, but I think it is a very, very important point. When we talk about interest rate, treasury bill rate is at 13%. I don't know how many of us have taken a loan from any bank, and the tenure of the loan is 3 months or 6 months. We go for a loan, it's 2 years, it's 3 years, it's 5 years. So on the yield curve, your comparator is not your T-bill benchmark or your Ghana reference rates, which is an interplay between T-bill, interbank, and the policy rates, which are short-term instruments. We are talking about on the yield curve, where can I see the comparator interest rate? And my friend has put it very eloquently. The government is borrowing 5 years for 18.5. If I'm a bank and you have a deposit with me or you are a shareholder in me, why do you think if somebody wants 5-year money from me, where should I lend when the government is taking it from me at 18.5? Should I go and give it at 16 and suffer the risk, the default risk, or give to government at 18.5 with zero risk? So it's almost a non-starter. Because on the yield curve, there are comparators that we must be comparing instead of always as for the reference rate is good, and it is a benchmark rate for us to know exactly where the baseline is supposed to be. And if you trend lending rates, there was a graph on the table, but on the present slide. And one thing that I paid particular attention to was how the rates were moving and in which direction. So if people say that the transmission is not happening, then when market rates are coming down, you should see either a sluggish follow-up of the lending rates or lending rates staying flat. But you saw on the graph that lending rate is declining even in a more decreasing rate than the market rates. Look at the start of the graph. You see that it is tipping aggressively. It tells you that rates have followed market fundamentals. And that is the point I made graphic, that the lending rate is a reflection of economic fundamentals. When policy rate was at 18%, then average lending rate was at 28, 29, sometimes 32%. Now, policy rate is at 13.5, average lending rate is at 20%. There is 800 basis points drop in lending rates over a short period. I'm talking about 5 years. 800 between last year and now, there's been 300 basis points reduction in interest rates. But unfortunately, as banks, we are not able to tell our stories, and the narrative has been lending rate is high. It is very easy to just throw it in the air. But if you look at the fundamentals, you clearly understand that banks are not fixing the customers, or we are counterproductive in the economy. When we talk about in COVID period, Ghana did not really suffer like other countries. We forget the role the banks play. That we restructured facilities worth over 4 billion. We gave 16 billion new loans in an uncertain environment. We did everything to keep the rules of the economy grinding. And that is something that we did not want to just go out there and say you need to take credit because we are in a pandemic. But then the narrative turns against us. So when the president said, I said, this is a very easy way around it. The fundamentals are in the hands of the president. They are, because when the fundamentals drop, the banks are full. And the history is there for all of us to follow. When we talk about efficiency in the banks, to be honest with you, I have worked in 6 different banks, and I know how banks really squeeze when it comes to cost. I was CFO for 3 banks, and cost control is in finance. And I'm telling you, even Bank of Ghana had the cost to commend the banks in the MPC report. That once inflation is around 9%, the bank's cost increased by just 5%. How many businesses in this country had year-on-year growth in cost of 5%? Banks are extremely cautious in expenditure. If you go there and you see all the nice things, we squeeze the people who supply us to the bone. That is how we do our procurement. So yes, there is always room for improvement. There is no perfect efficiency. So we take that on board and we inform our population to even look for more opportunities for cost savings. But as for efficiency, banks are one of the leading industries in this country when it comes to efficient production cycle or efficient production system. I'm responding to a few of the things that you said. Yeah. I talked about 800 basis points rates reduction in the lending rates just about 3 to 5 years now. The question we are not asking is when the banks reduce the lending rate, what is the transmission on the other side? The borrow is how do they transmit it into the reduction in the cost of other items on the market. We have only looked at the bank side that the policy rate decline, the banks have not reduced it. But when the banks reduce it, the transmission from the beneficiary, how do they also make it affect the cost of production so that our ordinary citizens can also afford the commodities that are on the market? Besides inflation to increase prices, when interest rate drops and we drop lending rates, how do manufacturers also reduce the prices of their commodities? We are not asking those questions. I think those are also very legitimate questions.
Could that be the final?
No, the final one is on non-performing. You know, we like to compare, and it's good. We compare Ghana to Nigeria, we compare to Cote d'Ivoire, and we compare to other countries. But we don't, when we compare where we are lacking, or where they are better than us. And sometimes we forget to compare one of the most important, which is the non-performing loan in this environment. How does it compare with Cote d'Ivoire? We are 17%, Cote d'Ivoire is 6%, Nigeria is around 4.5%. So if the lending rate in Cote d'Ivoire is lower than Ghana, there is a reason for it. The policy rate is 4.5, ours is 13.5. So there is a reason. And we need to tackle the fundamentals. If we allow the policy makers to shift the blame onto the banks, we will not solve any problems. That is the point. I have a few more, but since the time is
Those thoughts are more.
Yeah, I think that we have heard enough from the banks side. At least your your CEO, I'm sure has spoken for all of you. So maybe I'll respond briefly to them.
Right.
And then we go to somebody from government, and Minister of Finance, and then also bank account, so that we hear from
Right.
our side.
Then we also have online participants, so they can lift their hands if they are ready for questions, so that we can let them speak. Maybe
Okay,
one or two of them.
okay. So I hear you, I mean, first, so the general accountant, and then the CEO. Of course, I expected to what you have said. I appreciate them, and that's what I expected you to say, explain the situation and all that. First, let me start with this gentleman. He made reference to the Ghana reference rate, and he says that it has influenced lending rates downwards. I'm sure it's all the graphs that I showed you today, and over a 20-year period, is showing that every one of the variables has come down. There's no question about that. And it is because if you study this Ghanaian economy, you will see that in terms of, if you have gone beyond this to the earlier periods, you will have seen a lot of macroeconomic instability. Things have stabilized over the last maybe 2 decades. There's no question about that. And so that's why they are all come down. So when you say these rates are, respond to the economy, the fundamentals, and I think that comes from the macroeconomic stability. It's a determinant, legal determinant of all the others. But the interest rate itself is one of the measures. So once macroeconomic stability has declined, interest rates have also declined. But the concern is mostly about spreads. I think that's what we should focus on. All of them have come down. But how about the gaps closed? Well, this is the which rate is the multi-policy rate and the lending rate. So yeah, it's true that even at some point it closed quite a bit, and then it's it's expanded just a little bit. And that's why I'm holding everybody responsible, because you cannot come down below the policy rate. So the policy rate itself is a determinant of where the lending rate will be. That's why I'm asking that in trying to respond to inflation, we should also make sure that we don't fuel this high lending rates. So the person, the guy said that the current reference rate, the factors that go into it, examination, treasury bill rates, monetary policy, this is all of them are factored in. That's fine. So once they come down, the Ghana reference rate also comes down. But once they also go up, the fish back of Ghana reference rate up. So that is why T-bill rates, it shouldn't be where it is. People have made a lot of reference in terms of the yield curve. Okay. I've also said to government that they should reduce their borrowing from banks, so that yield curve in the treasury bill rates will also come down. I think the Bank of Ghana is concerned that banks are investing more in treasury bills instead of lending to the private sector. That's also a source of concern to Bank of Ghana. And because, as you said, the treasury bill is risk-free. You would rather put your money there than to lend to somebody who will not pay you back. So government is competing with everybody. And that's why I'm also put quite of responsibility. I think the capping part that maybe affects you more directly. I think that's the part. Otherwise, I'm asking everybody to contribute. But it looks like you are saying, if you cap this, you have made some statements that are very. You said Kenya tried interest rate cap and we heard about it. But what are the ones? I want to know the environment, what are the conditions in Kenya? And what so we have to take something for it. But I would rather I want to know exactly what the conditions are. Now, these caps, they are not practiced, it's not universal. I'm saying that, and especially in a system of liberal policy that's being practiced everywhere. If you mention something like regulate cap, then people are going to say, but it's because I'm even saying that if everybody did what I'm asking them to do, there will be no need for a cap. I'm only saying that because those things are voluntary and we have asked them to do it for, we are not doing it forever, then they be less interview. So if you promise me that, you said something like you have reduced your inefficiencies and that banks are more efficient and so on. But when I go to the banking box, I see the inefficiency. I don't have to tell you. I see it. Oh, you have improved. You have improved, but so you have improved. And then you said caps, interest rate caps have never worked anywhere. How many examples do you have? It hasn't worked in Kenya. Yes, but you have many examples. And that it is potentially disruptive. Those are very harsh words. If we impose it, it's going to destroy this economy. That's what you're saying. And this is because you won't lend to the economy. No. Maybe you will be mobilized the savings, you may mobilize the funds you need to lend in the first place. That's what I'm saying. So the economy will be a starve of credit. That's where you're going. Yeah? That's what we need us to. That's what we need us to. Okay. So please, I think I should modify what I'm saying. I'm saying that let everybody go and do what I'm asking them to do. Our organ is also going to act on government's direct, maybe and panel some aspects, all stakeholders, and then you brainstorm together as to what you are doing. I am throwing in this thing as a matter of but I'm not saying I'm not the central bank. It's not that. So I'm just throwing it in that if you do go and dialogue and you don't get anywhere, then that this will be the last resort or something. I think that I will stop here. Somebody from the ministry. Oh, somebody else.
Yeah.
Academia.
That's some
Academia.
Yeah. Dr. Abache, thank you very much for that wonderful and insightful presentation. As part of your recommendation and the way forward, can we think about the fact that the government can also set up commercial banks that it owns wholly, so that it can dictate the pace. For example, if it's given an interest rate of say 10 or 15%, then other banks may follow suit. It seems to me this is not very practical because the bank, the government in the past owned Ghana Commercial Bank wholly, but now it has given out most of its shares and it now owns just 21%. So if this is coming from the government side, then I suggest that maybe a bank that is set up for government and take the initiative in reducing this interest rates. Thank you.
But I thought I mentioned something like that, promoting para institutions. I think I said something like that. Sure. And you are mentioning, even this country, we don't even have proper community banks. They are the rural banks. But in other countries, America, for example, we have community banks. In other words, banks that serve particular communities. So maybe the equivalent is the rural banks. And then you have the general commercial banks, and here the universal banks. But I'm saying that we should support the rural banks more. then the National Development Bank is so on. You know, Kwame Nkrumah established the Bank for Housing and Construction, NIC, and then the other one, agricultural. Exactly, wanted them to take care of the strategic sectors of the economy. They removed them, those sectors from the mainstream. The type of kind of thing that was, yes.
Yes,
You are,
Federal Institute of Bank.
oh, please, we want to take the opportunity to Minister of Finance.
Finance.
and Bank of Ghana. You have had enough representation.
Yeah.
Yeah. No, she's a council for a bank.
Ministry of
Oh, yeah.
Finance.
Yeah, I'm not from Minister of Finance. Let's speak for the ministry. Please say something, say something.
So much for the presentation.
Okay.
What you have said, communicated management, what they are, I mean, what you have said, so the recommendation, communicated to management, and then the business.
You want to say management, you mean, Minister of Finance.
Yes.
But who did you address our communication? So who are you representing? Oh, okay, that's the director of the.
Economic
And the.
strategy.
and- Exactly. It's not very good. Yes, so we are giving you copies of the recommendation.
Yes,
So
please.
you take it. And let's see what you say.
Thank you so much.
Yes. And then Bank of Ghana, my colleague is here. You know, he is a member of the Monetary Policy Committee for as long as we are some, two of the most long-standing members of the committee. So he can speak for the bank and then the monetary policy. Because I've said a lot about the monetary policy and what does contribution to management. And then this suggested pathway.
Yes,
I'm sure my colleagues will just will say that. Okay, please go ahead.
thank you very much, Dr. Mache, for the attendees. I actually wish there was a lot of time to talk about, because as Dr. Kwaji said, you have actually raised a lot of things, and for some of them, I would have wished I had a lot of them delve deeper into them. But let me just start by first thanking you and the IEA for this opportunity to be here. I am actually representing my director, Philip, who I also wish to be here. For some other official engagement. Now, it is indeed a pleasure to have this opportunity to brainstorm on this all-important topic of high lending rate and in particular the solution. As you know, you have comprehensively covered the costs, and for the most part, these are things that have come up over and over again. And I am particularly happy that this time we are talking about the solution. Interest rates, as we just showed, clearly have been very high in Ghana, but it is also true that they have been declining and have declined to appreciable levels now, as you actually show from the highs of nearly 50%. We are actually within the, I'm not restricting it to the period we showed in the presentation. In the regions of close to 50%, we are now around 20%. And they still are high, and I'm sure every effort is being made to reduce them. The Bank of Ghana has been actually implementing very sound monetary policies to reduce inflation, which you know has a direct bearing on the interest rates. But also, you know, implementing reforms, as you're already aware, that will also reduce these rates. I.e., you have mentioned some of them, including the credit reference to low, the collateral reuse rate, and the rest, which actually seek, you know, reduce the cost to customers and the back of the banks, because absent is the information asymmetry can be very costly, and getting this information if you don't have a common platform can really be costly in that case. So the bank has been doing a lot, both directly in terms of monetary policy, reducing the inflation rate, and then also alongside reforms that actually, you know, increase the efficiency of these services that are provided. For lack of time, I would have wished to go through the details of the base rate and why we had to move from the base rate eventually to the current Ghana reference, rate. Unfortunately, I see we don't have that much time. So, but I also take consolation in the fact that the Chartered Institute of Bankers has already mentioned something. I would also have to concluded on that. Since the introduction of the Ghana reference rate in April 2018, we have seen, that it is actually influencing rates in the right direction, i.e. from about 16.6%, which you mentioned, we are currently around 13%, just almost in line with the policy rate. And it is also because of the whole philosophy around the Ghana reference rate, i.e. introduction of transparency in the way that these rates are determined. So unlike the base rates where you had all kinds of fixed cost of funds and all of it getting into the determination, this time you have a transparent way of determining this Ghana reference rate, which is also industry at the industry level. So you have the treasury rate, you also have the policy rate and the interbank rate, and these are weighted. And so if you look at the trend since its introduction, there's actually been good movement in the right direction. So this is what I would say. But let me move directly to the recommendations, and in particular the ones that affect the Bank of Ghana. Again, for lack of time, I will be able to go through all of them, but I'm sure I will also communicate some of all of these to our students as well. The issue, by the way, let me mention that Dr. Kwate is actually one of the longest to have served. He has served on the MPC figure for 10 years, and in fact, one of the longest serving members of the MPC. So I'm sure most of these things he's also talked about things that perhaps in the course of the service on the Monetary Policy Committee came across. But on the issue of the transmission mechanism, and in particular the very first recommendation, I unfortunately was a bit surprised about it that Dr. Kwate mentioned the monetary policy rate rather than dealing with the inflation rate, rather chasing the inflation rate. And I think that perhaps could have been maybe put in another way. As you know already, monetary policy is demand side policy, and it's true that we manage the demand side. But what is also true is that we also pay attention, especially under the current dispensation, where we pay attention not only to deviations of inflation from target, but also deviations from the potential output, i.e. the output gap. And I'm sure this is very much aware of. Now, a classic case is what happened last year. As you recall, when at the height of the pandemic, when there was this disorderly pricing and food prices shot up to almost 14%, sending inflation to a peak of around 11.7% in July last year. Around that same time, the monetary policy still cut the policy rate. And in fact, Dr. Kwate was then a member of the MPC, which means that apart from the demand side, we also pay attention to what is happening to the real sector of the economy. Although inflation had gone outside of the policy target, but we still saw reason to cut rates because at the same time that for that inflation, we normally would also look at what we call the core inflation and other rates. Is it a temporary thing? Is it something that is not, underlying? Is it something that is not core? Such that you don't react to it. So when inflation was even going up, we still had reason to cut the policy rate, which was because of the real sector of the economy, the output side. And so the FPC also takes into consideration these happenings, as I said already. Now, there are several of them that I will just touch on, perhaps the very last recommendation, which ties the before then, let me add what Mr. Duwa said on the Kenyan experience. In fact, actually, before the August 2016 experience of capping, there were actually two earlier attempts. The first one was in 2001 and it failed. The second one was in 2011, and that obviously had a lot of resistance from the bankers association, and eventually could not come through. Then there was this third attempt in August 2016, which eventually had to also be abolished. So on the issue of having maybe some caution might just be in place. And in particular, the issue of linking spreads within the banking sector, spreads from the policy rate to the reserve requirement. I see that as one that is potentially practically problematic in the sector. I mean, Dr. Pachi mentioned that as well. That he sees clearly that is potentially an area that will be very complicated and also difficult in that case. Now, just to add, one thing I would have also wished to see. I think I actually have taken note of all the recommendations, and I have noted them down. I will really report to my experience in the office. So I take note of one thing that actually I would have also wished to see, which perhaps can enhance this discourse. Now, if you look at the analysis you did on all the charts, and in fact, you even mentioned one thing that prior periods even showed more volatility. But even for the 20-year period, you would have seen a lot of volatility. So for the most part, you do all the work, you get to a point, and then a little shock comes, it throws everything out. You have to go up there and then start again. What do we do? Are there policies that can lessen the severity of such shocks in the economy? That is one thing that we have to look at, and it can be important in ensuring consistency in performance, which will go a long way to ensure that rates actually, instead of having to be that volatile, will come down. You will eventually see rates trending in the right direction with such resilience established. There are a lot of things that are happening in the system, industrialization drive. These are things that can potentially work in this direction and should perhaps be encouraged. Thank you very much. Comprehensive presentation.
Another one. But will you be those on Zoom also? Do you have anybody?
Yes, but probably after.
After that, please, and you bring those ones just a few minutes.
Okay.
You are from
My seniors have spoken. And so
and you compare.
I just wanted, because this is a recommendation to government, we can use ADB as a model case.
Okay.
Because with ADB and all the factors mentioned kind of come seen with us, where we used to be predominantly owned by the government, and then now the government has given up a lot of its hold on the market, the private shares. But the fundamental or the core business of the bank, which is being trumpeted by our managing director now, Dr. John Kofi-Mensah, which is agribusiness, has not been abandoned. During the peak of the COVID, where we have a lot of banks shying away from giving off loans or credits to businesses that seemingly were struggling in the economy. And we still have our big loans as low as 10%. So we have the weighted average of interest rates out there in the public. But let's look at the product basis, product by product. and some other banks can also emulate our example where on product basis, the rates can be skewed down to help the customers. So the image being created out there, you know, the banks have high lending rates is not entirely true when you look at it on bank basis. So our mother bank can assist, the government can also assist in looking at these on bank basis, and then try to kind of bridge all the banks to a certain minimal level there, so that the pricing can be reduced. Some can come and showcase a very low interest rate, but then when they're looking in, like you said, the customer has already been taken on. Then you have them bringing the other hidden charges, which they didn't initially communicate to the customer when they were trying to hold the customer on. And then absolutely not, we do not do this at all in ADB, where you have retired your loan early, and then we're charging you for early retirement of the loan. So this can be something that the government can help in making it across board for all banks, so that customers do not struggle in terms of that. And a lot of banks were closing their branches during the peak of the pandemic. Some folded branches, and made it inconvenient for a lot of customers, because you have to travel longer distance with all these barriers to specific branches before you could bank, where you join the bank probably because of their networking based on where the location of your business is. ADB, we didn't hold all our branches remotely. We were open for a long time. We went to all our branches, we were open. We waited till things something out until it got too difficult, and then we still left very key branches in Accra, Kumasi, but the remote branches were not open for business, especially in the north. They were very happy with that. So that's something at that time the government could have, come in and seeing the way the branches were forming, could have intervened at the time. So there's a lot indeed the government can do to assist in this regard. And we thank you very much for your recommendations.
Thank you. It's the Zoom people going to bring it.
Okay,
This would be, can it be expanded a little to make it bigger?
Okay, I think the first question is about access to credit and cost of credit have remained major challenges to industry for years. For our AGI business barometer, Mura's vision has not worked in driving the L rate or the lending rate down. So I think that is the first comment. Is it? That's no comment. It's more of a comment. Okay, a committee was set up about 10 years ago to come up with a common base rate formula. This helped for about 8 months, and the banks returned to status quo. Okay, they returned to the status quo. So there is also a comment. Bank reference rate has not worked either, and legislation for capping on lending rate may not work. Case studies exist in Kenya, Nicaragua, etc. It shows a downward in credit growth, and access to credit became difficult. just like I think Mr. Elias comment. This is our industry need medium to long-term facility, which the banks seldom offer recommendations. So I think this is also about the same thing Mr. Wage. Government borrowing must reduce. Banks must reduce their high operating costs. I think this has been mentioned already. Government must reconsider the taxes levies imposed on the banks. Borrowers bear the brunt sunset clauses on such taxes must be adhered to. So these are comments from our online participants.
I think we are looking on.
Okay. I think I have one question. If nobody has a question here.
No, the question for
Does anyone have a question?
no, I think we should bring it to
And then, okay.
So let me thank you for coming because we are taking too long. But as I said, we give you copies of the recommendations. Please, just I don't know we have before Thomas you have said I'm saying that I want all parties to contribute.
Dr. Patrick,
Yes.
you have a voice in this country, and banks give of these contractors loans. Okay, and then government takes time in paying these contractors. And so if a person has come in to loan as it, the time the person finishes paying off the loan trustee, the person that really lost all the gains that they would have made from the business. But government took a long time in paying them. So you see all these factors into the banks giving of loans and then the interest which they want to also pay. You know that in case the person defaults, because sometimes the loan can go so astronomically now becomes like for these contractors.
Yeah. So please, I think the CAP is the most controversial one. So leave it to the end and say that all the parties should pay their parts in the joint, and then let's see what they have. The CAP should be the last resort. Because I'm sure people will not have that people will buy. So let's keep it as the last resort. But I'm sure some of the things in the media are going to read that. And I don't put it out there for debate. You know, it's not like let's debate it. I'm provoking discussion. So it's okay. If I hear that the majority of opinion is on this, that's fine. Not a big deal. So thank you so much.